Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Excellent. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and Market Chameleon and I are not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All righty.
Share my screen here. And if you guys are joining us for the first time and you have a question, you can put that question into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, click on the button, raise your hand. You don't have to turn on your video camera, but you'll be able to ask your question live and direct. If you have questions about the Market Chameleon tools, data analytics, you want to talk and discuss strategies that you're using that may be working for you, and you want to share that with the rest of the community, or you've seen something unusual, you're welcome to come on a show, discuss it. I think it will benefit everybody. While we're waiting for any questions to come up, we'll start out with the pre-market report, take a look at what's coming up on the earnings front, maybe discuss some of the valuations. If a question comes in, I'll stop and take those questions.
Perfect. Let's roll.
Right. So here we're on a pre-market report. And these are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, 154 stocks made our percentage gainers list, 40 on the decliners. So right now, from that perspective, looks like a more bullish bias at the open. Let's filter out this list to S&P 500 stocks only. So we'll take out any ETFs, leveraged products, small cap stocks, preferreds, closed ends, all those stuff. We'll filter out just to see what's going on in the S&P 500 stocks. So I'm going to come up here. I'm going to select this in ETF. I'm going to drop this down and choose SPY. And by doing that, I'm filtering out this list by the holdings in SPY, or basically the stocks that make up the SPY ETF, and SPY mirrors S&P 500. So basically we're looking at S&P 500 stocks. And here we see 32 stocks made our percentage gainers list, 4 in decliners. So right now we're setting up, looks like for bullish bias at the open, using these stocks as well. And I believe Google came out with earnings, Microsoft, they're both up over 3% so far in the pre-market hours. Trying to kind of look at the Microsoft's earnings, read about it a little bit in the morning, but I'm still going through it, so I don't want to say too much. It does look like it was a pretty good report, though. Revenues were increasing. I think they guided also that they're going to be growing. Here's their outlook, that they're going to be growing here, at like a 10% or in double digits. So far, at least from Microsoft, and I think Google earnings look pretty good. But I'll read a little bit more about it today, see if we could talk about it, more later on. Here on the earnings front, so I came up here under earnings, looked at the calendar. So let's take a look at that. And keep in mind, today is the Fed meeting, right? So today we're expecting to see the Fed raise interest rates by 75 basis points. Then I think that we'll get some more guidance, what they're thinking going forward. But that's going to bring what our yields up to 2.5%. Will, is that correct?
Yeah.
Fed funds. And we'll see if they continue. I think that right now the expectations are for another 0.5 point increase, so that'll bring us up to 3%. And if you guys look at the long bond, which is unusual right now, the expectation is after we go up, the Fed's going to start decreasing rates next year to stimulate the economy. So I think that whatever the market is looking at, they're seeing that the economy is going to slow down to the point where they're going to have to start stimulating as soon as the first half of next year. So we'll see how the Fed feels or how they guide us. But this is the earnings calendar. These are earnings expected to be released today. So over here we see these are the symbols and the names. So Meta, Facebook, expected to report today after the market close. Qualcomm after the market close. We see a couple have been reporting before the market, prior to the market open. T-Mobile, Bristol Myers. Here, before the market opens, here is the press release. So you see the time that the press release was issued. And if you click on it, it takes you over. You could read about their earnings release. Here, this is important too. This indicates when the management's going to have a conference call. So a couple of things they do. They'll issue a press release. You could go read it. Usually you'll have the financial statements, the company talking about the highlights of their financial statements. Sometimes you're going to get guidance. Sometimes management will talk about their, key metrics. And then a lot of times the management will have a conference call. And that's what these are. This is telling us, what time management will have a conference call. That could be even more important sometimes than just the press release, because then the management really discusses and explains what happened, what they're seeing regarding their business. Sometimes they talk about their future outlook. Analysts get to ask questions sometimes, so they're answering questions. So you get more insight from management, in these conference calls, which is a supplement to that press release. And so you want to kind of keep here's one. Boeing, they've reported earnings, so this is out. You could go kind of take a look at their press release. I just clicked on it. You could see here they talk about free cash flow, all this good stuff. I'm not going to read everything through right now, but if we go back here, we see that Boeing will also have a conference call 10:30 a.m. So that's after the market opens. So pay attention to that, because we could see more movement in the stock, right? Right now we are seeing a reaction. Stock's up 2.9%. But when the management talks and starts answering questions, providing more insights into the current earnings, what they see going forward, that could have just as much an impact on that stock price. So something to pay attention to is those conference calls. Very important.
Yeah, and traders are looking to see how the leadership of these companies view the overall economy, right? Sometimes they give insights into what they are seeing as far as looking forward.
Right. And it gives you like how confident is management going forward. It's really insights into the economy a lot of times, especially these big companies, because they're seeing how customers are behaving, and that impacts their own behavior, what kind of investments they want to do, hiring, and so forth. So extremely important, when you listen to this management's discussions and what they're guiding or their outlook into the future. let's take a look if there are no questions so far, Will. Let's take a look. I was looking at QQQ. And here's some insights maybe we can take a look at. Actually, let me start out here. So when we look at the QQQ, right, we see, which is the Nasdaq heavy. So the QQQ, Nasdaq 100, consists of, I would say, a lot of growth stocks, right? Technology stocks, a lot of growth stocks. And we could see here that year to date, if we compared it to the overall market, we're down 25% versus, SPY down 17%. In the last 6 months, Nasdaq was down 14.3% versus SPY down 9.1%. So from looking at that so far, those tech stocks, the growth stocks have been underperforming the S&P 500. And if we take a look at their fundamentals, right, let's just take a look at their fundamentals. And one of the things that we know is impacting the market is interest rates moving higher. Everything's kind of pegged to the risk-free rate in the financial world. As interest rates go higher, cost of capital is increasing, valuations, asset prices get repriced, right? So here's the question. I wanted to see what people think. Why do you think growth stocks would get repriced lower than regular S&P 500, right? So growth versus non-growth. So we could see here's the debt to equity, 0.81. So I'll show you that compared to the SPY. So as far as a proportion of debt to equity, SPY I think is at 1, or around close to 1, QQQ 0.81. We see they have a good return on equity and assets, and EBITDA yield 6.7%. So let me show you that compared to and here are the risk-free rates. So 10-year right now, 2.8%. We see that's been moving up. So here's a 10-year, 5-year average, 1.9%. 3-year average 1.5. We're at 2.8 right now. 2-year at 3%. And here's your EBITDA yield. So let's just take a look at that. You see the risk-free rate? It's going up. So the risk-free rate right now at 3%. And this EBITDA yield, which are earnings before interest, taxes, depreciation, amortization, that's gone up on the QQQ. And one of the reasons the way it could go up is that either earnings go up or asset prices come down, right? So, and right now we kind of have a little bit of both, but the earnings yield is what you're paying for the assets, right? And how much you're earning on them. So if you're earning the same amount and you're paying more for the assets, the yield on your invested dollar goes down. The less you pay, the yield on your invested dollar goes up, right? So think of it this way. If I'm expecting $1,000 in cash flow in earnings, if I pay $100,000 for that asset, I'm only making 1%. But if I'm paying $50,000 for that same asset and I get this $1,000 in cash flow, then I'm earning 2%, right? So it's what you're paying for the asset matters on your invested dollar, how much you're yielding. So here the yield has been going up, right? And I think it's a combination. I believe earnings are still increasing. This is the 1-year growth. And you could see asset prices, total market cap came down. That's increasing this. And the risk-free rate is going up, which is impacting it, right? that's why asset prices are going down, because the spread between risk-free rate and risk assets, it's narrowing, so something's got to give. But why would anybody can guess why would that the QQQ get repriced faster than the SPY? So let's take a look at SPY. So what did I say? Debt to equity was 0.8. So look, as far as the equity, debt to equity, you know, proportionally SPY S&P 500 carries more, has a bigger EBITDA yield, 7.4%, and their growth, right, is not is expected to grow as fast as the QQQ. So I wonder if anybody knows. Well, let me know if you get any answers, but I might just go ahead and I think you're
nothing's popped up yet.
All right. So one of the reasons growth stocks will get repriced down faster is because it has to do with it has to do with the discount cash flow, right? So the present value of $1 today is more than in the future, right? So when you're saying growth, when we're talking about growth, you're projecting here's the cash flow going forward, you know, year one, then it's going to grow year two, you're going to grow through year three, year four, and five, right? But that same dollar amount in year five is, as the risk-free rate is going higher, that same amount in year five is all of a sudden worth less in present dollar value, right? Because if I could earn interest on my dollar today more than before, then that dollar today is worth more to me than that dollar in the future. So that's one of the reasons that growth stocks can get repriced to the downside and even to the upside much faster, because their cash flows are projected to be increasing out into the future, right? So it's like, you know, like the dividend discount model or the cash flow discount model. Everybody putting in their model, as the risk-free rate is going up, the present value of those cash flows, you know, $1, think of it this way, $1 today is worth more than $1 5 years from now. And as interest rates go higher, it's even worth more than that. Okay. So that's one of the reasons why we're seeing. So I guess the point is that I'm making is not necessarily that the Nasdaq 100 will perform much worse than the S&P 500, you know, because the stocks could be doing fine and they could continue to earn the same amount as projected, and the S&P 500 can earn exactly, you know, what was projected, but the cash flows into the future are getting discounted, you know, to the present value, and that's why one of the reasons we're seeing a bigger reprice in the growth stocks. But if there are no questions today, maybe I'll just stop right there. You know, we discussed Fed, right? You're on mute, Will.
Sorry about that. One question popped up earlier from Bob. Maybe it's something you can review. We can go over tomorrow. Just you'd like to look maybe at the fundamentals of Shopify. I mean, it's something walking through live, you know, without any look is hard to do. So we could do it tomorrow. We have, you know, only a few minutes left.
And I think they're reporting. They've been reporting earnings, right? So let's see if we could. I'll take a look at their earnings. Maybe we'll review it tomorrow.
All
since
right,
they
perfect.
Just came out. Yeah, this way we're looking at the most recent data, and you know.
Yeah, and it's off.
I don't want to sit and read it while you guys are waiting, huh?
Yeah, it's off. It's like 70-80% from its high. So and I know it's a big, for small businesses, it's a big service they use. So it's worth looking at for everyone. All right, cool. We'll do that tomorrow then.
Yeah. So, I mean, I could look just really quick. Now, this isn't looking at today's data yet or their forecast or what they might be saying on a conference today, but here I'm just looking at, again, this is growth, right? So we're looking at a growth stock and, I could see they're not making any margins right now. They're basically trying to grow their revenues, kind of like Amazon's grown.
Yeah, I think I read they went from 1,600 employees 3 years ago to over 10,000.
Right. So their capital expenditures are going up. They're producing growth here, right? You got to then project what do you think the margins will be in the future, so you could kind of estimate their cash flows, try to figure out what that would be but here, look, if we are giving operating margins, we're giving them 8%. And if we're saying they're going to grow at 60% year over year for next 5 years, right? If we do that, we think relative to the market, it's about a $19 stock. Basically, for you to, here we go. These are the revenues. If we grow them at 60%, right, with an operating margins of 8%, this is what you will earn, right? So your return, even with all that growth rate, and an 8% margin, your return over 5 years is 24.8 versus S&P 41. So there, it doesn't look that great, right? And if we just normalized it to the S&P to get that 41%, we're looking at a $19 stock.
That's interesting.
Yeah, and look, they're trading 5 times book value, so 9-10 times sales. And again, growth stocks, as interest rates go up, remember, growth stocks will get repriced much lower, because if you're waiting for that cash flow to start showing up in 5 years, right, that means the present value of the cash flow is worth less and less in present value dollars, as interest rates go up, as the risk-free rate is moving higher.
It looks like we may have something that may have to be adjusted. It looks like the 52-week range may not have taken in the adjustment in this.
Yeah.
Something
let me take a look at that. Yeah,
all right, cool.
That doesn't look right.
Maybe we'll look further at Shopify tomorrow. And obviously, it's a big earnings week. I think Meta's, so we'll have a lot to talk about tomorrow. Awesome job, Dave.
Yeah. All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.